It's almost 7:15, and it was on this day, 5 years ago, 2009, that interest rates dropped to their current level of 0.5%, 0.5%. It was also back on that day, in fact, that the Bank of England started pumping money into the economy through quantitative easing. These easy money policies were designed to encourage spending and keep the economy alive after the crash, but they haven't helped those who are trying to live off their savings. Simon Rose is from a campaign group, Save Our Savers.
We reckon that savers have lost something like £326 billion in 5 years from lower interest rates and from the effects of inflation. McKinsey calculate that the net loss to people, even and above the benefit from cheaper mortgages, is £110 billion. Both inflation running out of control and also cost of imports being higher has meant that everybody is actually poorer. The people who've benefited really have been the government and the financial elite in the city. I'm afraid that low interest rates and QE have been the biggest source of wealth inequality in this country for centuries.
Well, Paul Lewis presents Moneybox, as many of you will know, and joined us now. Morning, Paul.
Hello, Evan.
I mean, we are actually in extraordinary times, and you can live through 5 years of it, and it stops feeling like it's so extraordinary that effectively you get nothing on your money.
Yes, it has been an extraordinary time, and, you know, you can't really disagree with those very, very big numbers that Simon Rose has worked out there. It's been a transfer of wealth from savers to borrowers. Basically, people with mortgages have been protected, particularly those with interest-free mortgages, interest-only mortgages, protected from their foolhardiness, you might think.
Well, tracker mortgages, if you had a tracker mortgage, you've done astonishingly well.
Incredibly well. But, you know, just to bring it down to the personal, away from all the hundreds of billions, because I've been doing those calculations as well overnight, but if you take somebody who had £100,000 in September 2008, and there are a significant number of pensioners who've saved up all their lives, want to live off that money, supplement their pensions. They would on average have got over £3,000 in income from that 100,000. Today they'd get 760. They have lost 3/4 of their income, and even if they were rate chasers who looked for the best rates, exactly the same. They've lost 3/4 of their income, a bigger amount, but still 3/4 of their income gone. Now that's a pretty devastating loss for people who are relying on that to boost their pensions.
It's too late for them to save more or to work more and make that. But I mean, the Bank of England obviously says pensioners, no one would have been served if the economy had been left to grind into an abyss and the banks had all gone bust. So one has to obviously take that into account.
Yes, absolutely. I mean, no one knows where savings rates would have been without the policies. But the point is, if you're that individual who has seen their income go down, the counterfactual, if you like, where it would have been, doesn't really interest you. They might have been worse off. We don't know. But that is the effect on their income.
I wonder, Paul, whether in looking back at economic history, the lesson is that savers ultimately are screwed, because they're the ones who put their money into some institution or lent it to somebody or invested it in a company, and they're the ones who are hoping to get it back. And of course, if too many people have lent badly, or if the institutions into which they put it haven't done very well, it is the saver who pays.
It is, but of course savers, in the sense of cash savers, wanted to avoid those risks. If you'd invested money, you know, if you'd picked the right moment in the last 10 years to put your money into a tracker fund, you'd have doubled your money practically today. And, you know, even going back to 5 years to when this policy began, you'd certainly have be 20% up or something like that. So people who invested have done better than people who saved, but that they are willing to take that risk. And of course there will have been moments when they'd have lost money. Savers are the very, very cautious, and it's the very cautious who have been punished. And as Simon Rose said, quantitative easing did push inflation up for a while, and that also has hurt people with savings.
Paul Lewis, thank you.